Are you able to hear me now? Can people hear me? Okay, great. Sorry about that. That is very strange because I did test the microphone before we began and it was working and suddenly it stops. Okay, let's start that from the top. So here we are with number 6 in our Advanced Aspects of Trading course. This is about trend confirmation. If you join me for the previous 2 weeks, we've been looking at trend analysis, and we're continuing with that with the idea of trying to use some more information to improve our trend analysis, and that's where this idea of confirmation comes in. We're going to be looking at momentum, oscillators, and more. If you joined us for the first presentation on trend analysis, you'll recall that we went through the idea of Dow theory, and one of the parts of that theory was the idea of confirmation. And I've also mentioned that each time we've looked at a different piece of analysis that I've said it's very important to look for confirmation. So that's really what it's all about today, looking at how to confirm what we're seeing with the trend. And we'll look at what we mean by that, and different ways we can do it, and some problems with certain elements. Before we get into the talk, let's just remind you of the disclaimer. It's very important to take a look at this. Have a good read of that. Just remember that everything I talk about today is purely for the purposes of education, solely for giving you information to make informed trading decisions. Nothing I say when we look at charts and looking at indicators on those charts, you shouldn't be taking that as any kind of personal recommendation or any advice. So the agenda of what we're going to cover in today's talk, we're going to have a little introduction to the idea of confirmation, why it's important, what we mean by confirmation. Then we're going to look at using volume as a method of confirmation. We'll also talk about some of the problems you might encounter trying to use that. And then we're going to introduce the concept of momentum, specifically price momentum. One of the ways that we look at price momentum is a variety of oscillators. We're going to look at a number of oscillators. We'll explain what an oscillator is, and we'll look at those as used as momentum indicators. So we'll be looking at quite a few indicators, and really that will be a major part of the talk, is looking at a number of oscillators. And as usual, we'll finish up with a question and answer session. So confirmation, we've got a quote here from Jeff Yass. According to Forbes magazine, he's one of the 50 richest people in the US. He's the CEO and co-founder of this company, SIG, which is Susana International. It's a quant trading company with it does institutional broking and fund management, all under a kind of quant trading banner. And his quote here, it says, "If you can give up your ego and listen to what the markets are telling you, you can have a huge source of information." So the idea is about looking at what we're seeing with trend, and then looking for other pieces of information that are out there to try and help us and decide whether that information we're seeing or that decision we're making about trend is correct. So confirmation. One of the problems that we've mentioned already is that with any indicator we use, or any method of trading really, when we look at technical analysis, there's always this problem of false signals. And it follows then that if we can find a way to try and make better decisions or weed out those false signals, that's going to be a great help. It's always, if we're looking for ways to improve the quality of our signals. So one way to do that is to look for confirmation. And when we talk about confirmation, it's using another indicator, information from different sources. Ideally, that would be from an unrelated indicator. In other words, an indicator that isn't using the same pieces of information that we've already used to make our decision about trend. So one of the original methods, and we talked about this when we looked at Dow theory, was the idea of using volume as a confirmation method, but there are others that we could do. So let's talk about volume. It's one of the general principles of this is that volume is an indicator of activity and liquidity. And the idea being that there's been observed a tendency for volume and hence activity to increase when price fluctuations are large. So one of the things that we've been very interested in looking at are breakouts, when we see maybe the price moving in a sideways range and then price breaks out. And we have said before that that might be an indication of a change in the trend happening and maybe the formation of a new trend. And what we're saying is that perhaps you could look at volume, and if you see a spike in volume, that might be supportive of the idea that this is a valid breakout and a greater chance of a new trend. But if the volume isn't there to support it, that might be a reason to be skeptical. So as this says here, if we have two similar moves, the one with more volume is seen as more significant. So this is a general line of thinking when it comes to technical analysis. In other words, it's a check on the validity of breakouts, reversals, and so on. So what exactly do we mean by volume? When we talk about volume, the strict definition on an exchange would be how much of an instrument has changed hands in a given period. So if we were looking at a share, if we were looking at IBM on the New York Stock Exchange, then it's how many shares in IBM have actually traded in that day, not the number of individual transactions. So it's the combined number of shares that have changed hands. So stocks, the number of shares traded. When it comes to things like commodities or index futures, it's actually the number of contracts that have traded hands. So those on exchanges, things like commodity futures, index futures, interest rate futures, the way they work is that you have this fixed amount of them that's known as a contract, and that's what trades there. And the volume would be the number of contracts that exchange has. We have a slight problem when it comes to volume. And actually, let's just come back to that in a second. I'm just going to quickly go over to and share the eToro platform. Can someone give me, just type in the name of any share? Any share? Someone said McDonald's. Okay, let's do McDonald's. So here is McDonald's. If we want to, this is just to show you how we might look at volume on eToro. We have an indicator button where we can bring up a list of indicators. We saw this last week. I'm just going to, very, very easy this, go down to volume. Shares, if you want to see it, there's some volume data that has appeared at the bottom there. So we can see that the volume on certain days is higher, certain days it's lower. And we can actually see the volume picked up quite a lot. You know, if we were looking at this, trying to analyze, we might say, okay, this move up, is it a significant move? Well, having what we just said is that kind of general line of thinking. We've got quite big volumes, particularly here on the end of October, where the market is starting to bounce back. So we would sort of apply, if we decided that move was something we're interested in, whatever our analysis on it, we would look at that volume and say, well, there is a good level of volume going through. Maybe that gives some validity to it. But as I said, there are some problems with volume. So let's go back and go back to talking about what those were. So volume can be misleading for markets where there is significant arbitrage. So this can be often the most popular instruments actually can see this. Now, what we mean by arbitrage is a kind of way of doing a risk-free trade where there's what's called an arbitrage opportunity. It's where there's a mispricing that allows you to put on two trades that effectively render no risk to you. You're just taking advantage of the mispricing. So if that in a situation where that you may see volumes going through where volume levels aren't responding, they're not an indication of the validity of the price move. They're actually just telling you about the fact that there's an arbitrage situation that's been there, and that's why that volume went through. So it can obfuscate really what's going on. This is compounded a bit more by some modern problems, algo trading or programmatic trading, which has increased the proportion of arbitrage trading in recent years. So as a consequence of this, volume data isn't as useful today as it used to be in years gone by, especially for very heavily traded instruments where there can be this large proportion of algo trades, sort of distorting things a little bit when it comes to the volume data. We also have a problem that volume data only exists for certain things. If you're looking at foreign exchange, you're never going to have any true volume data because those are decentralized markets that are off exchange, and there's no volume data that is ever published and therefore ever available. Dark pools, these things exist where volume is going off exchange to other areas. Maybe people don't want you to see that they're trading and they go through these other liquidity pools off exchange, which therefore affects what we actually see in terms of actual volume from the exchange. And as I say, volume's not available for OTC products. Other confirmation methods are available that we can use though. So we talked about moving averages. We said, if you recall from last week, that a moving average is a lagging indicator and that we use it as one of the methods of using it is for confirmation. So moving averages actually are a confirmation tool, although they are accessing price. So it's not using unrelated data, which is not ideal. They are, if you're looking at a very long-term moving average, that is going to confirm the trend quite nicely. We can also some people have tried to use indicators based on open interest. Open interest is on futures contracts. Sometimes exchanges will tell you how many contracts remain open for a given trading month. It's not particularly useful. It's not that, it's up for grabs, up for debate whether how useful that actually is. And then there's this idea of momentum indicators, which is what we're going to focus on. Computers make technical analysis much easier to manipulate the data than it was in the old days. In the old days, when the sort of originators of many of the most famous indicators, they were actually recording things on a piece of paper, plotting their charts on paper, and the calculations they were doing, you couldn't manipulate the data that easily. With computers, it's really very easy, and lots of complicated methods have sprung up over the years. Whether that actually improves things particularly is debatable, but we're going to look at some of the more popular momentum indicators. So confirming price using this idea of momentum. So what is momentum? Well, it looks at the rate at which price movements are changing, how fast, or whether they're accelerating in the direction they're going or whether they're decelerating. As I say, is the slope of the trend becoming steeper or more shallow? When we first started looking at trend lines, we said that a trend can start off very fast, but maybe it can decelerate, and that will be, you'll see that as the trend line you redraw your trend line and it becomes shallower. If it becomes steeper, then that is actually things picking up momentum. So a steeper slope, the price momentum is increasing. Shallower slope, price momentum is falling. So most momentum indicators, and we're going to look at a number of momentum indicators, incorporate this idea that if the price is moving too fast in one direction, it might mean that there's some kind of reversal on the cards. We do need to be really careful with this, though, because we have to bear in mind what we said from Dow theory is that the primary trend is the thing always that we're most indicated. So we have to always bear all this idea of possible reversals within the wider picture of what the main trend is doing. So this is a really simple example, just to show you what we mean by momentum, price momentum. We've got a table showing a number of days and then some sample hypothetical prices for a hypothetical stock, XYZ company. And we can see that on the first day, the price is 100, on the second day 102, the third 105, 107, 108, and 109 on the fourth, fifth, and sixth day. And then this third column on the right here shows us the price change. So from day one to day two, there's a 2-point change in price. From day two to day three is a 3-point change. And then as we continue, 2 points, 1 point, 1 point. So we can see from the price in the column in the center, the price is rising. It begins at 100. There's never a day where the price declines there at all. But if we look at the actual change, we can see that by the fifth and sixth day, the pace of the increase has actually gone down while price has carried on going up. So the momentum is easing. And what we might think is possible from this is this might be a sign that trend of increasing is running out of steam. So we can use momentum indicators, things that actually are designed to look at just precisely this thing in different ways, can be used as gauges to either confirm the trend or make us think, hang on, that's not confirming the trend. They also are thought of as possibly being leading indicators, warning of a change in trend. So can you recall that we talked before about we have lagging indicators like moving averages, coincident indicators which show a change as the change is actually happening in price, or leading indicators, ones that show a change before it becomes evident in price. So the idea is that momentum indicators possibly can have some kind of leading indicator quality. And we have this idea of a convergence, and that's when we see confirmation between momentum and what the price trend is doing. So in other words, if the momentum indicator is showing momentum's increasing, price is still rising, that's a convergence, and it tends to be supportive of the idea that the trend will continue. And then something we talk about probably a bit more is divergence. Divergence is when we see disagreement between what price is doing and what our momentum indicator is showing. So for example, if prices are rising, but momentum is not rising, we're not seeing new highs in the momentum indicator, it can be a warning signal of a possible change in the trend. And many momentum indicators are what's called oscillators. Oscillator basically means it just goes up and down. We are going to have a slide to talk about what oscillators are in just a second. So oscillators, they don't have to be, but often the value of them tend to be bounded between two extreme values. So you get these two types of oscillators, ones that are bounded, and they tend to sort of only go between 0 and 100, let's say. And then unbounded ones where there isn't this fixed level, but they do tend to move in a very similar way. These things, they basically move up and down. And the way that the oscillator works is it tends to look at what price is doing, or volume, or whatever the oscillator is being applied to, and works out these are the range of price movements that we would expect for the vast majority of time. And then if it ever gets the oscillator pushing beyond those levels, it says, hang on, these are extraordinary price moves. Perhaps it could be a reversal might be on the cards. With that same caveat, we have to do this within the context of what's going on with the trend. Trend is always what we're primarily looking at. Our oscillator is always secondary information, and it's secondary to just helping us color our thoughts about what's going on with trend. So when we look at an oscillator, we have these higher levels that are called overbought, lower levels are called oversold. And this next bullet point is really saying what I just said. Oscillators by themselves have limited use, and you really do need to bear this in mind. Some of these are really popular, some of these oscillators, some of the ones we're going to look at. For example, let me just go back to the eToro here now, and if we flip over to gold here, what I've got here is so price charts of gold, and you can see I put some general lines on there just to sort of indicate what's going on. I've got a moving average moving here, and at the bottom, this is a popular oscillator called stochastic, and we don't need to worry too much about what's going on with stochastic, but just to give you the general idea, we can see that it has this blue area in the middle that shows this is the normal area. And then when we get into the outer bounds, the overbought and oversold regions, they're above and below. And we can see that what the oscillator does, it goes up and it goes down, and it occasionally moves out of these regions. And we can't, there is always a temptation to just look at the oscillator and say, and I think the reason that this temptation is so strong is because partly it's because they're so clear and easy to look at and say, oh, that's overbought. That means that, there's too much buying, it's going to move down. It doesn't necessarily mean that. We've always got to bear in mind we're looking first at price. So in the case of gold, we might be looking at gold and saying, okay, let's have a look at the longer term. This is the weekly chart of gold. The longer term trend has been sideways, but then has been moving up for the last year. The trend has been up, so that longer term trend is up. And then on the daily chart, you might say, okay, look, the actual trend over the last few months has been downward, but it's a very gentle downward trend. And within that kind of context, we're then looking at how these overbought and oversold regions have behaved. In terms of gold, actually, they've done very well. If we look at, we get an indication of the most recent overbought area is up here in October, and we can see that price has turned lower since then. So let's talk a bit more about these oscillators. So high levels are called overbought, low levels are often called oversold. We have to be careful. Those aren't just simple things that mean buying. We can't just respond simply to that with overbought means sell and oversold means buy. We can't do that. Common usage, as I've said before, is to look for the divergence from price. So this is the really, I would say, the most useful element of it. So rather than looking at overbought and oversold, which are often misused, best usage is to look for divergence from price as a thing telling us we're looking at the trend, we're trying to make up our mind, okay, I think I know what the trend is. Let's look at the oscillator and see if we get agreement or disagreement. If there's disagreement, I'm going to be a little bit worried about what's going on with that trend. This final point is signals can be particularly useful when price is contained within a trading range. So you are not a really great, oscillators, but they give you these overbought and oversold indications. They're most useful when you're not in an up or down trend. When you're in a sideways trend within a trading range, those can be quite useful for indicating regions where there may be a tendency for the price to turn around. But by the same token, in a heavily trending market, and a market that's persistently trending, you're going to frequently get false signals of overbought and oversold from your oscillator. Unless you put it into context with the trend, those aren't going to be useful signals. So, for example, if the market is trending upwards, you're going to get lots of overbought indications over and over and over again. And if you were to sell those, you're going to end up with a problem because the market's trending up. So as I said, they're often used incorrectly. You can't just focus on those overbought and oversold signals. You have to, can't say it enough, you have to pay attention to what is happening with the trend. That's your context into which your momentum indicator fits. So the trend is our primary concern. And that goes back to one of the first things we said when we began with the first trend analysis, that what technical analysis is most concerned about is identifying the trend, trying to get on the right side of the trend, ride that trend. So momentum indicators, we mustn't lose sight that they are secondary evidence. Our primary evidence is what's going on with trend. We're using this to confirm or disprove what we think we're seeing with the trend. Now, some indicators attempt to actually mechanically incorporate the trend. So they actually almost put on things onto the indicator themselves to sort of force you to pay attention to the trend and not just focus on overbought and oversold. So let's just talk about some common ones. There are tons of oscillators out there. These are some of the more important ones. So rate of change, ROC. It's a really simple one. We'll be talking about that in just a second. Moving average convergence divergence, most commonly known as MACD. That's the most complicated one out of all of those, and that's the one we're going to spend the most time looking at, just because there's quite a lot going on that one. It's a pretty comprehensive and involved indicator, so we'll look at that one. Relative strength index, probably the most important, popular one out of these, I think, and we'll also take a look at that. Stochastic, we mentioned. Stochastic, William percentile, commodity channel, index, CCI. All three of those are very similar. Oscillators in general do tend to work in a similar way. If you're using an oscillator, just pick the one that you think or have found works the best for you and stick with that one. There's no real point in using two oscillators at once because they're all just telling you the same thing. So really you just want to use the one that you think works best for you. Commodity channel index, although it's called commodity channel index, it was devised originally to be used on commodities. It can be used on anything. The name doesn't restrict it only to commodities. Williams percentile and commodity channel index are very similar to stochastic, which in turn is not that difficult from the relative strength index. We'll talk about relative strength index, but we're also going to talk about general usage of oscillators, just to give you an idea about what the similar things that are similar to all of them. So the standard way of using oscillators, 4 standard ways. The position of the oscillator relative to zero. So they always have this 0 point and they're oscillating around this to levels away from that, either up, above or below zero. Position relative to zero may be an indication of the underlying trend. In other words, if your oscillator is above zero, it tends to indicate it, quite simply, that you're in an uptrend. If it's below zero, it tends to indicate that the trend is downward. Got this idea of divergence again. If you're seeing divergence between an oscillator and what you're seeing in price, then it may signal that momentum is changing from the previous or existing trend. We've seen that they give indications of overbought and oversold levels. I'll stress once again, this has to be used with care. They can give you indications where there might be a likelihood of a reaction to the current price move. So as long as you're bearing in mind if prices, and if you think that the trend is up and you see that you're getting an overbought signal, you might think twice about selling that. However, if you saw an oversold signal, you might think, well, this is a reasonable opportunity for getting into that trend. And then crossing the zero line can in itself be used as a trading signal. So if the oscillator is down in the negative territory, it crosses over that 0 point up into the positive territory, that might be an indication of a buy signal, and vice versa. And then a final caveat, the evidence that any of this works is not conclusive. A lot of these things, when they're put through mechanical testing, don't perform that strongly. And part of that may be just down to some of the things we've been talking about. There is an element of judgment and expertise involved in trying to work out what to follow and what to ignore when these, you can't just mechanically follow overbought and oversold. It doesn't work. So rate of change, ROC, it's an incredibly simple oscillator, one of the simplest ones here. Just to measure how much price has changed over n periods. So you decide how many periods you want to operate this over. It looks at how much price has changed, and it calculates it this method. It looks at the current price. So if you're looking at a daily ROC, it would look at the end of day price. It would subtract from that the price of our n periods before. So if we were saying the 10-day ROC, it would look at the end of day price 10 days ago, subtract that from the current closing price, and then divide it through by that price 10 days before and multiply it by 100. It tells you in a kind of, it gives you this number that tells you how much it's moved. One of its characteristics is that it's giving an equal weighting of the furthest price to the newest in the calculation. And that means that, let's say that the old value, so we said, for example, a 10-day ROC, if that value 10 days ago was a very big value, all its comparison is where it is today to where that was 10 days ago. If that number just suddenly drops out and then it's a much smaller value, you're going to see a big change in your ROC. It makes a big difference. So the value of ROC is susceptible to fluctuations purely by this idea of numbers dropping out of the calculation. Some of our other oscillators that we're going to look at are a bit more complicated and a bit more nuanced in terms of their calculation and what they're looking at, and won't be quite susceptible to this kind of thing. Standard usage is with n equals 14. So if we're looking at a daily chart and we just go with the standard usage, it's looking at n equals 14, 14 days ago, what was the price compared to the current price, does the calculation. So here I've got a screenshot of a chart of Apple. It's a daily chart of Apple. And I have put the ROC down at the bottom of the screen. This is with the default value, so it's a 14-day ROC. And really what we need to pay attention to. So first of all, we can see that this is the ROC is what's called an unbounded oscillator. I said you get bounded and unbounded one. ROC is an unbounded oscillator. So the values will change according to what instrument you're looking at. If we're looking at Apple, or if we're looking at the S&P 500, or we're looking at Tesla, the values that the ROC sort of oscillates between are going to be different according to the instrument. So you need to look at what's happened historically to try and give yourself an idea about where these extreme levels might be. If we look at the chart here of Apple, we can see, very roughly speaking, that the upper range is around about 15 and minus 15 on that one, maybe a bit lower. And we can see, so if you see that getting up to that kind of level, you might start to think, hang on, is there a tendency for a reaction to the current movement? Possibly. We also want to look at how price is moving in relation to the indicator to try and give us an idea of whether they've got divergence or convergence. So let's have a look. Go back to the actual chart platform so we get something a bit more dynamic. And I'll go here. I'm just going to look at General Motors. So I'm going to, at the moment, I've got this volume at the bottom. I'm just going to get rid of that, and I'm going to add on. I'm going to add on the ROC. Rate of change. There we go. At the bottom of the screen, it's a 9. This one is actually putting a 9-day ROC on. So that, having said that 14 is traditionally the default, the way that the Toro platform operates is it uses 9 as its default. So we can change this by, if we want to change that to 14, we can just put in 14 here. And you can see it doesn't make a great deal of difference to the chart. It makes some difference. Whenever we see default values, play around with them, see if you can come up with something that works better for you, that is a superior number. And what do we see here? Well, if we look at the ROC, we're saying that a general usage of these is crossing through the 0 level as perhaps an indication of a change in things. If we look here where it's crossed a couple of times from positive into negative, we can see that the market has been in a kind of downward trend following that. If we look at what price is currently doing, I want to try and put on let's zoom out just a little bit. We sort of draw on a very rough trend line onto price here. We can see that the price of General Motors since August has been in this downward trend. And then we look at what's going on with the ROC. We can also see that there's possibly some divergence going on here, just in terms of, although we can also see a similar kind of trend going on here, there's just a hint. If we look at these levels down here, at the bottom of the rate of change, that it's not quite doing the same thing in terms of this level is much, much higher. I mean, although price did pop up there, we probably just want to keep an eye on that because there's just a hint of divergence that I'm seeing there between this downtrend and this behavior of ROC. We'll see some better examples of divergence as we go on. Let's go back to our presentation. Okay, so moving on from RSC, we're going to talk about the MACD, the Moving Average Convergence Divergence Indicator, MACD. So in this moving average convergence divergence, it incorporates two moving average lines. So it's like a variation. If you recall, last week that we spoke about moving averages, we said there was this dual moving average crossover technique where we put a longer one and a shorter one. And then if it crosses up the faster one below through the longer one, that can be a buy signal. If it crosses below, that can be a sell signal. So it's a similar sort of idea here. So what MACD does is it plots two exponential moving average lines. The standard default usages are the 12-period EMA as the faster moving average and a 26-period EMA as the slower moving average. So this is part of its calculation. And then the actual MACD itself, which is the main part of the indicator, is the longer one subtracted away from the shorter one. That gives you the MACD. So it's the difference between the two lines. And then that gives you values that oscillate unbounded above and below zero. So if it's got a positive value, that suggests that average prices in the short term are greater than prices over the longer time frame. So that's why if it's above zero, it would tend to be a kind of bullish signal. If it's below, it's a bearish one. So this screenshot just shows you an example of opening the dialog box for the MACD. And we can see that it asks for three different inputs: a fast MA period, which we've got 12, slow 26, and then signal. So there's also this other input line, which is for this signal line. We're going to don't worry about that just for the moment. We're going to talk about that in a second. And then if we put that in, then it would plot the MACD at the bottom of the chart. You can put it at the top if you want. And we can see there's quite a lot going on there. We've got the black line is actually our MACD line in this one, and then the red line is our signal line. And we've also got this histogram. The histogram is actually the difference between the two lines. Yeah, so as I say, the signal line is to explain what that signal line is. So there's the signal line is MACD is the difference between our the longer EMA subtracted from the faster EMA. And the signal line is just a moving average itself of the MACD. So it's a smoother version of the MACD. Default value is 9 periods. So then you get these two lines, the MACD, which tends to move a bit more jerkily than the smoothed out signal line. MACD crossing that tends to be an indication of what's going on. And then the histogram is the difference between your MACD and your signal. So what does it all mean? So the most basic indications from the MACD indicator is that when the MACD line itself, the main line, is above zero, if we think back to how it's calculated, it means that the shorter EMA, the faster one, is greater in value than the longer, the slower one, and that suggests an uptrend. It's a bit like our, it's when we have plotted the dual move over crossover, it's the shorter one being above the longer one. And then MACD below zero, that's the shorter EMA, the faster one being smaller in value than the longer trend. So the nearer trend is bearish. That suggests a downtrend. And then when MACD crosses zero, well, that's like a cross of our two moving averages, because when they're crossing, their values are equal. We get a zero value when they're subtracted from each other, and that may be a breakout signal. So these are the basic indications. And there are some more things we can do with MACD. So some additional possible ones. If MACD is above zero, indicating an uptrend, whilst MACD crosses above signal, that might be a buy signal. So it's MACD crossing above signal, but we also need MACD to be above zero to follow it. If it was in the negative area, then we would not consider that a buy signal. Similarly, MACD crossing below signal in an uptrend is not necessarily a sell signal. And then we can compare peaks and troughs of MACD to price for the confirmation divergence idea that we talked about. And we can also do the same with peaks and troughs of the histogram. And the histogram can also suggest changes in short-term trend within the larger trend. So you keep an eye on histogram to see what it's doing, just to give you some kind of idea of short-term trend changes. And then it's an unbounded oscillator, as I mentioned. So to get an idea of where the overbought, oversold regions are, you need to look back at what it's done to get an idea. So let's have a look at an actual chart with it on to try and give you some idea of how we might use it. So this is a daily BP chart. And I've got the MACD at the bottom of the chart. And that's just with default values. When we talk about default values, what we mean are these are the person who originated the indicator. These are the levels they recommended, and they arrived at them via trial and practice. And they're the ones that are recommended. You don't have to use those, as I say. It's always, though they're considered the ones that are most affected by the person who invented it, so it's worth paying some attention to that. At the same time, always worth playing around just to see if you can find something that works more effectively for you in current conditions, because conditions are always changing. What I've got marked on this MACD at the bottom, I put some green circles and I've got some red down lines. Now those green circles, those are indicating where we're getting crosses of MACD line above signal line whilst MACD is in the positive area. So these are sort of buy signals. And if you compare what price is doing at those points, we've got the first green line, price rose quite sharply after that. If you look at the second green line, we can see price will continue to rise after that. This third one, roundabout in October, we can see that after a sideways period, we got this buy signal and price did push on from that. And then in February, this is February of 23, we can see we got another buy signal, and we can see we've got a very sharp upward movement in price at that point. And then I've also marked on these red down arrows, which are just for the histogram troughs. And if we actually look at where those histogram troughs are, they do tend to line up quite nicely with where there's a sort of, we've seen a big dip, but also we see that we kind of get a pause in the trend and they match up with big drops in the trend. And then a key point really in the middle of this chart, well, around about August and September, this is a nice example of divergence between price and the histogram. So we can see price has got this clear trend line marked on, but if we look at what's going on with the histogram, we can see that the histogram's not giving you an indication of upwardness. It's losing strength in the middle of that trend, suggesting that maybe it's going to run out of steam. And we can see eventually it does. I mean, it persists for quite a bit longer, obviously. Let's go back to the eToro platform and look at an example. So we can actually put on that BP here. Get rid of our rock and put on MACD. So first of all, these colors are different to what I've shown there. You can configure these colors quite easily. Go to settings. We see we've got the default settings: fast length 12, slow length 26, signal length 9. These are the default settings. Style, I quite like to have the signal as the smoother line. That's a deeper red. That's a little bit more opaque and a bit fatter. And make the MACD itself, I'm just going to make it black. And we can see this one has the colors as the histogram begins to decline. It gets a paler color as well, which is quite useful. If we look here between June and April, yeah, so really this is see we've got a kind of upward trend here of price. But if we look at what we're seeing in with the histogram in this area, it's telling a very different story. So I would say that's a pretty good example of divergence, indicating get yourself ready for a change in trend. Well, what do we see? We see this big negative move in the price. We can also see that with this uptrend, we got MACD in positive territory here in August, and a cross of MACD above signal, which is a possible indication of a buy. And we can see that we did get the uptrend. And then along with the divergence from the histogram, we also saw it crossing below, which is sort of giving you a warning, hang on, there might be a change of trend happening. And of course, histogram plunges into red, and we can see it all tallies up with when the market sold off. And then finally, the relative strength index, the RSI. So I said before, this is one of the most popular oscillators, really very popular. It was invented by J. Wells Wilder, who we've mentioned before here when we talked about average true range. He invented quite a few things: parabolic SAR, stop and reverse, average true range, relative strength index, and average directional index as well. So what the RSI does, it assigns strength value to an instrument by comparing up days versus down days. So it's this slightly interesting concept. You just look at, was this an up day? Was that a down day? And we're going to try and assign strength according to that. And then from that, you derive a value. We'll look at the calculation in just a second. If you're seeing a number of days where you're seeing day after day of gains, then it starts to give you this overbought signal. If you're seeing loss after loss, then it gives you an oversold signal. Typical oscillator, in other words. So the calculation, it isn't all that important really to know how this works, but it's worth just having a kind of general idea just so you know what's going on. So the standard value is n equals 14. So you look at, it was originally designed to work for days, you use end of day data, and that's more to do with when it was invented. And as I said before the invention of sort of easy access to computers. With computers, it's very easy to calculate it as shorter or longer, whatever you want, and it can be applied to any period. It doesn't have to be just days. And the up value is you sum the gains over n periods, divide it through by n. The down value, you sum the gains over n periods, divide through by n. And then you define relative strength as being the up value that you calculated divided by your down value. And then the final step is to convert it into this oscillator that between 0 and 100 is a percentage value. RSI equals 100 minus 100 divided by 1 plus RS. So the RSI is similar to many oscillators. You get these clear indications of overbought and oversold, which we have to treat with care. Once again, divergence with price warns of a possible change in trend. Wilder also stressed this idea of failure swings, which is a chart pattern when RSI shows overbought or oversold, is a strong indication of a reversal. So I've got a little diagram that will show you what a failure swing is. It does tie in with what we're going to be looking at next week, which is chart patterns. We're going to be looking at all these sort of things, and also candlestick patterns. And then Wilder also was of the view that you can apply kind of technical analysis to the RSI itself. So you can apply trend lines to find support and resistance in the RSI itself. So a failure swing is when price goes up, hits a high, pulls back. As we know, price moves in sort of peaks and troughs, and then it goes up to push through and fails to make a new high. So it pulls back to a level of support. This is an example of a rising market, but the same applies in reverse for a falling market. Market pushes up to a new high, comes back and finds support, bounces back towards that high, but fails to reach there. And the pattern, the failure swing pattern, is completed when the market pushes through that previous support that it found. And that is, according to classical pattern recognition, a sell signal. If this occurs when RSI is in overbought territory, then that would be a strong indication of a possible reversal. And then vice versa, if it was a falling market and it happened in oversold territory, it's a strong indication of a possible reversal. So general rules for the RSI: readings over 70 are an overbought signal, a potential top. Readings under 30 are an oversold signal, a potential bottom. For the umpteenth time, I'll stress, within the context of what's going on with it, you have to bear in mind what's going on with the primary trend. These are the values recommended by Wells Wilder, 70 and 30. Some analysts use 75, 35. I've seen some people even use 80 and 20. It's up to you, whatever you think yields the best results. The value of N in the calculation dictates how sensitive the relative strength index is to changes in price. You play around with that. Bigger the number, well, make it bigger or smaller, the more or less sensitive it's going to become. So lower means that if you're doing it just over a fewer number of days, then it's going to be more sensitive. You're going to get more overbought and oversold signals. Use a higher number of N, it's less sensitive. You can get fewer overbought and oversold signals. So here is a chart with using Apple once again. With the I've got a couple of RSIs that I put on the bottom of the chart here. Having said you should only use one at a time, you just made it more convenient to put two here. They are pretty much the same thing. They're both RSI. One is with 70 and 30, one is with 75 and 35, and they're both using the default 14-day value for N. This is a daily chart of Apple. Now what I've got here is I've marked on some divergence where we can see that there's a slight, we're getting new lows in at the price of Apple back in June of 2022. And then if we look at what the RSI is doing, the RSI is, we've got a line joining the troughs of RSI, and we can see that it's actually flat. So it's not making a new low when price is making a new low, which is divergence. And that would be a possible indication of a change in trend. What do we see? Lo and behold, price completely reverses and pushes up after previously being in a downward movement. And if we look at what happens between August and September, we get this overbought. It's very, depends on the lower RSI, it's clearer, but they both give an overbought indication, and price does reverse. Especially, we should note that it's what we see in terms of the price action is a failure swing. So we can see that the price pushed up to made it, kept. In this whole period when it was in the uptrend between June and September, you see that it's making new highs each time it meets significant resistance. But in the middle of August, makes a new high, pulls back, meets some support, bounces, fails to make a new high, and the pattern is completed when it breaks below the previous support. And we had an overbought indication when we got the failure swing, and we do get the big reversal. And let's actually go back to the platform again, just to put, I'm going to look at the S&P. I'm going to get rid of my MACD, and I'm going to put on RSI, Relative Strength Index. We check our settings. It's a 14-day RSI, and middle is 50, upper limit is 70, and lower is 30. So if we wanted to change that and do 75, 35, we could do that. We can see if we put them higher, that we get fewer. There's another way of getting fewer signals because it's harder for it to break out of that range of the sort of bounded, the inner bit that says it's not overbought or oversold, the normal areas of movement. Now we can see an uptrend here on the left, so I'm going to mark that on. So we see we've got a kind of uptrend here in price. But if we look at what the RSI is doing, so for a lot of that, we are seeing an uptrend in the RSI, but what we see is some serious divergence here. Let me just grab another trend line. So while we can see price was making new highs, the RSI wasn't. And we do get a reversal after August into September, and where we're looking at currently, it's been on a sort of downward march ever since. So, our summary. We can look to confirm price movements through volume or price momentum. We said we talked about volume and some of the difficulties of it. One of the advantages of price momentum is that the data for that is readily available, very easy to use. It has the hindrance, of course, that it's not ideal in that it's not really completely separate data. It's in some ways just manipulated data of the same thing we're already looking at. We always use momentum oscillators as secondary indicators. Observing the trend is the thing we're most interested in. So our primary analysis always starts and remains our primary observations are about what's going on with the trend in price. And then we're looking at the oscillator as a secondary thing to try and confirm our analysis. Strong momentum suggests a trending market. Weak momentum suggests that the trend may be running out of steam. As well as confirmation tools, oscillators can do these other things where they provide some kind of leading signals, where they're not just confirming, they're possibly giving you indications of changes in trend. Overbought and oversold signals. If you only take away one thing from this presentation, I hope you bear in mind that they must be used with care, and at the time they're at the most effective is when we're in a sideways market, ranging market. That's when overbought and oversold are can be used with the most confidence. Okay, so that is the end of the talk. We have a few moments for questions. If you go to put any questions you have in the Q&A section, that will be great. Had a lot of comments that there was no sound in the Q&A. Someone asked, it would be great to see RSI opinion on cocoa price. For 1 year, it shows great trend, but what can I expect for next trends? Okay, let's have a look at that. So this is cocoa. We look at, I'm going to put on a weekly chart to get, we can see it has been in a very strong uptrend, as the question said, for about the last year. So this is a trend line during the weekly charts. It looks slightly different when we're looking at the daily charts, but still pretty much holds true. If we look at the RSI, and remember this is with my 75-35 RSI, so we can see that it's, what we can see is that those overbought and oversold, I mean, let's just tweak it, because it's not actually giving us many indications at all. So let's put it back to the defaults of 70 and 30 just to play it at the default levels. So once again, you're seeing this is what you would typically expect to see from an upward trending market with an RSI, is that you get lots and lots of overbought indications. And we can't just blindly sell at those levels because they aren't indications. They have to be seen within the context of the upward trend. We understand it's an upward trend. We know that these might just be like temporary points of resistance. And we can see that it does, when it goes overbought here, it does tend to sort of show you a small reaction to the trend, but it doesn't create a change in the trend. And at the same time, it fails to give you good indication. I mean, although the RSI turns around, it doesn't give you an oversold indication at all, even though it is meeting these support levels. So your trend line is actually more useful when it comes to support. You see our trend line is actually doing a pretty good idea of letting us know where that support might be. So ignoring the oscillator for a moment, we might say, okay, there's no indication so far that this trend is running out of steam, and we might expect our trend line, we'll keep an eye on it, but we might expect to see support coming in somewhere in that zone of the trend line. We can see with regard to the oscillator, we have got a couple of overbought indications. The first one of which wouldn't have done us much good. The second one, we might say, okay, if we're looking for a kind of take a bit temporary, we do feel that it's done a reasonably good job of showing us small reversals within the context of that larger trend. And the only other thing really that the RSI could tell us in this situation is to look for that divergence. And we could say we are seeing some in that we're seeing new highs in the trend. If we look at what is happening here, it tends to be a bit flatter. Maybe it's indicating a run out of steam, but I would trust more myself what I'm seeing the trend, and I would probably analyze the trend more with using things like moving averages as well as my lagging confirmation tool, and use the RSI as a kind of short-term secondary piece of information about possible kind of shifts in the smaller turning points in the undulations within the context of that larger trend. That I wouldn't look at anything on RSI and say, I've suddenly lost confidence in that trend. Looking at this as a hypothetical study that I've looked at for 5 seconds. As always, pay attention to what actually is happening because markets can change. Okay, let's go back to presentation and the Q&A and see what else we've got. Someone asked, exponential moving averages are better than simple moving averages, ? We talked about this last week, and I would say it's not decided. I don't particularly think exponential moving averages were designed with the intention of making something that's better than a simple moving average. I don't think it necessarily tells you all that much more. What an exponential moving average will do, because it's weighted towards more recent data, is that it will move a bit more quickly, but at the same time, price moves very quickly. Price moves with price. A combination I have used in the past is an exponential, when I talked about using a dual moving average cross. So let's go back to the charts and actually try and put something on a chart. And someone else asked, can you make an example using multiple different indicators for an experiment? Yes, I can. So let's go back to our chart and let's put something like Let's have a look at Microsoft, which is quite interesting recently. So here's Microsoft. Just going to get rid of RSI for the time being. And right, what are we going to do? Okay, so let's put on a couple of moving averages because we're talking about the moving averages. So what I'm going to do is I'm going to put on a nice long moving average, and I'm going to make that a simple moving average. I don't think my longer moving average, I don't particularly care about it being weighted towards more recent prices because I'm going to make this nice and smooth. So this has just gone on as a 9-day one, but I want it to be longer. What I would like is for this to be, let's say, I'm going to say a 50-day moving average. So this is my 50-day moving average, nice and smooth. And then I create a kind of crossover signal line, which is going to be an exponential moving average. In the chat, someone's asking why a 1-day chart. It's for the purpose of, I mean, I find daily charts are pretty useful because a lot of these indicators were originally designed to be used with daily information. You don't have to. We could have looked at anything, but it's always what it defaults to, and it is quite a nice thing to look at. I mean, we can shift that in a second if we really want. So I'm going to change this to an EMA. I'm going to make it, it's a fast one, so I'm going to make this a bright green line. And I'll make that a 10-day EMA. Now, if that was an SMA, it actually wouldn't make a huge difference to what's going on. So it really, in terms of, if I was to make this an SMA, you can see that the difference is absolutely minimal, really. So I wouldn't, I mean, they're pretty much doing a similar thing. Exponential moving average is just designed to change a little bit quicker or respond to more recent data a bit more heavily. You'll find that by and large, it doesn't make a huge amount of difference. They're doing the same thing. They're smoothing out the kind of perturbations in price, the oscillations, the fluctuations. How much it smooths is a function of how many periods you do it across. So trial and error will give you the right answer. And you know, to really arrive at what is useful, you need to look at a lot of previous charts and find, you know, it's not just a case of looking at one or two. You've got to look at lots and lots, fiddling with those values, seeing which overall gives you the best results. And don't cheat yourself, because sometimes it's very easy to look at a historical chart and say, okay, I would have done this, I would have done that. Let's add on some more indicators because someone wanted something to do with multiple indicators. So let's also put on the MACD. So what's interesting about Microsoft at the moment is that it's at this, if we look at that, how high it is, we go to a weekly chart and zoom out, and we can see that we're at an all-time high. We're at historic highs, big upward movement. We can see the, I mean, you can just eyeball what price has been doing, but also you can see with the blue SMA is the 50-day one. We can see like most of the time, apart from this period here, that's been an upward trend. And let's have a look at what the MACD tells us. So what's interesting with MACD is we have got this trough in the histogram. The signal line is the blue one here. That's crossed below, well, it's actually just picked up. So With these recent green candles, it actually seems to have given some fresh impetus to the MACD. And we can also see that the histogram is actually just pinged up back into a green territory. So, I mean, using that in the concept of saying is secondary information, my indicators in terms of moving averages are looking bullish. The EMA had turned back towards the slower one, but the slope of the slower one is up, saying, uptrend. The faster one has just turned back up with price saying uptrend. There's a big gap between the two saying uptrend, and my momentum indicator has just turned upwards. So in terms of trying to put it all together, it's a bullish chart at the moment, or it has been bullish, and there's nothing I see in that. Once again, it's a hypothetical study to sort of say, there's nothing from the MAC. There was something from the MACD saying it was running out of steam, but it has sort of turned tail and is now saying, actually, that's got a bit more bullish again. And can I peek at the NASDAQ 100? Yes, I can. Let's get rid of the MACD. Let's put on, well, for fun, let's put on stochastic, which we haven't really talked much about at all. So the way stochastic works, it is calculated in a slightly different way to the others. Stochastic plots two lines. One of the lines is called percentage K, which is sort of either known as stochastic or fast stochastic, depending on which package you're looking at. And then you have a slower line, a smooth line, which is percentage D. If we look at this here, we can see, sorry, this is the IMAs. If we go to the settings for my stochastic here, so percentage K is blue as a default here. So let's make the, I always like to just let me know what it is. I prefer it just to be a fatter line and a paler line. And that just makes me know that's my smooth. So what stochastic does is it sort of looks at the current price and it subtracts from it. You look over it, it compares price over a certain period and looks at the range of price over that period. So the default values for stochastic is 14 days, or this is on weeks at the moment. Let's put it on days. So it's a 14-day stochastic. It goes back over a period of 14 trading days. It looks at the high and the low. It says, okay, that's the range, the highest high over the 14-day period, the lowest low. It then takes the current closing price, it subtracts that low value, divides it by the high minus the low, and that gives you your percentage K, or I think it might convert it into a percentage and multiplies it by 100. And then that's our blue line. We can see it's a bit more jittery than the smooth line, percentage D, which is just a 3-day moving average of the stochastic. Now you can also apply a smoothing to the stochastic, and then in which case that becomes what's called your fast stochastic, and then your slow stochastic is a moving average of the moving average. It's basically just a difference in smoothing. But what you've got is the blue line moving through the smoother line is your kind of signal line. You can see it gives you all sorts of things, and it gives, it's giving you lots of indications all the time. And it also gives you these overbought and oversold signals, which is very typical of an oscillator. And we can see that it's bounded between 0 and 100. Okay, so the NASDAQ on this daily chart, if that's what people are interested in, has been in an uptrend. Very roughly drawn on there, but seems to have shifted out of an uptrend into something more sideways, although we can see that the troughs are getting a bit more punchy. So I would say this has a sideways look to it. but the market has just tested this resistance. This support is a bit more like up there, but the market has been trying to push through that, but not really succeeded because it's found the support in the end. We can also, I mean, in a way, this is narrowing, isn't it? Ever so slightly. So, but overall, it looks more sideways than anything else. If we look at what our moving averages are telling us, the blue is the smoother, longer one, and so that actually has started to get a bit negative. Our signal line has crossed below it, our exponential moving average, but is moving back towards it with this current thing. But it's starting to get a bit, it's sideways, but with a kind of bearish cast to it. If we look at stochastics saying, well, so one of the things we said about oscillators is in a sideways market, they do a very good job of picking these turning points. And we can see that when the stochastic, for example, this one up here, stochastic gave us a warning a few days before saying overbought, and then the market moved down. And when it got down to here, stochastic had told us round about here, oversold, and it bounced back. So in the sideways market, once again, overbought here, does a good job. But you've always got to be wary about this. Might be when we talked about, we've had uptrend, trend has changed into a more sideways thing. It's when that's happening, it's that battleground between the bears and the bulls. Someone's going to win in the end, and it breaks out. So you've got to be wary if you're just happily, I'll range trade that. You can do it quite nicely with this oscillator. When the breakout happens, you're going to be at risk of being caught with your pants down. So you have to have some good risk management. Risk management is one of the final talks we're going to do as part of this course. Okay, so we've run out of time, unfortunately. Thank you very much for joining me this week. Sorry about the problems with the microphone. I don't know what's happened there because it was working just before I began the presentation. Suddenly it stopped. I'm not sure why. I hope you enjoyed the presentation otherwise, and I'll see you next time. Thank you very much. Goodbye.